Now, these days, the stats around ETF use by SMSFs is quite astounding. In fact, 1 in 2 ETFs bought on the share market is bought by a self-managed super fund. So a fair question, I think, is why don't more APRA-regulated super funds invest into ETFs? After all, they're proven to be transparent, they have fantastic performance, they're very tax efficient, they're ultimately great investment vehicles. Why aren't more super funds investing? And I think there are really 3 key industry reasons holding back more super funds from investing into ETFs. The first one, and unfortunately probably the most impactful, is asset consultants. Now, asset consultants is an industry of people who go and make recommendations to super funds around how they should be investing, and generally the trustees of super funds are obliged to listen to these expert asset consultants. But my observation is certainly that asset consultants have a huge conflict of interest in that their whole business model is around recommending actively managed funds. In fact, if asset consultants simply said the best thing for you to do would be investing into ETFs, it would leave very little for them to do and for them to charge the super funds for. I haven't met any asset consultants who have simply said plonk your money into low-cost index funds. And so unfortunately, as the gatekeepers for most super funds, this is a huge blocker into more super funds investing into ETFs. The second reason is related, which is that most super funds have big investment teams. They have a CIO, they have analysts, they have big investment teams. The whole model is built around trying to pick fund managers, pick stocks, time markets. If you were just investing into low-cost ETFs, it would make a lot of these roles redundant, which isn't within the appetite of a lot of these super funds because they like having these big investment teams. So unfortunately, another conflict leads to less use of indexing and more use of active management. And the final reason, I think, is that there's just a lack of awareness and understanding of the actual research and data behind this. When I talk to a lot of people in the super industry, even trustees of super funds, there is a huge lack of understanding of how few active managers and active bets actually beat a low-cost index fund after fees and after taxes over the long run. And I think, unfortunately, this lack of education and the lack of understanding really drives a lot of this decision as well. And if people were better educated in the industry as to how poor the odds were of the strategy that they were putting their members' money into, we would see more super funds simply plonking their members' money into sensible long-term diversified ETFs rather than trying to do any of these more sophisticated high-cost strategies that the evidence clearly doesn't support.